For more on the impact of tariffs on China and other emerging markets, let's bring in PIMCO Head of Emerging Markets, Pramol Dhawan. Pramol, it's great to have you back on the show. Let's start right there with China, because just earlier today we heard that David Tepper's Appaloosa is, going full throttle, even more so into Chinese stocks or stocks tied to China. And we have seen signs that the K-Web is breaking out here. Is China investable right now as you see tensions rise with the U.S. and tariffs being slapped on the economy?
Yeah, we would worry very much about a long-term strategy that favored Chinese equities or Chinese debt. Short-term, sure, these are equities that could rally. But when you take a step back and you take a look at what this administration is doing, this is an administration that has deep ideology around sanctions and tariffs with regards to China. We've really learned two things. So there's two types of tariffs. There are transactional tariffs, which is what we saw with Mexico and Colombia and Canada, where there's a defined outcome. Tariffs are used to sort of accelerate a conclusion, and then those countries can sort of move on and move forth. And then there's the more structural tariffs, which are revenue-raising tariffs. And the administration is conducting a very deep and thorough review around those types of structural tariffs, which is expected to be concluded on April the 1st, after which we'd expect Europe and China to suffer from deeper, more significant tariff imposition.
So in light of that, if we're talking about structural tariffs on China, what does that do in terms of impact on the Chinese economy and those trade flows? Who benefits if some of that manufacturing continues to go elsewhere?
Yeah, we really think about the Chinese economy as having three separate parts, and two of those parts are really struggling right now. You mentioned the property sector before. The property sector continues to remain very anemic. The second part, the domestic demand and consumption and investment, is also very, very weak. The third part, which has been working in China, has been the export engine, and that's the part which is most at risk for tariff imposition. I think that you will see a continuing of dollarization for domestic Chinese to move assets into dollars and away from RMB. And ultimately, we feel very concerned about the long-term value proposition of Chinese equities. In fact, when you look at the MSCI World Index, the greater China exposure is almost 50% of that particular index when you factor Hong Kong and Taiwan. And China, with its back to the walls, with the imposition of aggressive sanctions, which is what we expect, aggressive tariffs, which is what we expect from the U.S. administration, is one where you have to factor a rising tail risk for geopolitical risks with Taiwan and Hong Kong as well.
And finally, Pramol, I wonder how you think about the relationship between China and India. You talk about some rotation out of China into India, but I look at the INDA ETF. It's really been kind of in the doghouse for the past several weeks, down near 50, even as some Chinese-related ETFs tracking the broader market there are up a little bit. Is it as simple as a rotation one way versus the other, or what do you see happening if people are looking at the potential of a pair trade?
Yeah, we continue to think that India will outperform China structurally, despite some sort of cyclical volatility that you may see. In fact, you're already starting to see concessions from India with regards to tariff. They've already looked at reducing tariffs on 30 different U.S. goods that are currently under a tariff regime. They're looking to increase their procurement of defense and energies. And when we break down structural versus transactional tariffs, India sits into that transactional element where they have the ability to be able to get deals and to be able to move on from them. And then you sort of think about the resulting impact of that is that it allows the economy to release its capex spend. It allows investors, both domestic and international, to invest with a lot more confidence there. So we think structurally be more overweight India than you are versus China.